This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, December the 9th, 2015. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term confidence and sentiment. This month I'd like to cover a range of topics listed here. I'd like to briefly revisit what we have been saying over the last year and how it currently is playing out with our predicted M-top. I'd like to discuss what we are seeing regarding the credit cycle. All indications are that it has turned, which has significant ramifications. I'd also like to discuss 6 very unusual market anomalies that we've been witnessing recently. For well over a year, each month, we have laid out increasing concerns we had with the financial markets. Our concerns didn't say that the market would crash, but rather the risk was dramatically increasing for the rewards offered. The truth is, when markets are being controlled or manipulated through central bank policy, traditional signals are distorted, or in some cases completely broken. Central bank policy is aimed at stimulating demand through the assumption of the wealth effect. These historically unusual central bank policies have been highly successful in this regard. The question is, at what cost and what unintended consequence? A chart like this suggests times should never be better. But that is not what is happening on Main Street for the average person, the middle class, etc. That's just simply not what they're experiencing. For investors, however, until recently, it has never been better for them since the post-financial triage policies were implemented. The first leg of our M-top evolved as expected, including our expected deflationary period associated with a breakdown in commodities, as we laid out in our thesis paper, The Globalization Trap, and specifically with the emerging market echo boom concept we spelled out. A cornerstone of our M-top theory was that we would complete a megaphone top. This has unfolded as shown here by Robert McHugh based on the Dow Jones Industrial versus the S&P 500 on the previous chart. We laid out in the study section of our MATA document well over 2 years ago the significance of this pattern at major market reversals. Nothing is ever 100% probability, but it sure has worked well for us since the post-financial crisis bottom. Another important part of our theory is that markets repeat in cyclical patterns. These patterns are observed at various degrees. Think of degrees as patterns on a monthly basis versus a daily basis, for example. When you see this pattern happening, the chance of having the right pattern are much higher. The megaphone is one such pattern that is often seen. These patterns are not just sine waves, but often are non-periodic repeating cycles as laid out in the work by the famous mathematician Benoit Mandelbrot, which I've studied quite extensively, by the way. This more detailed chart from Robert McHugh shows that a smaller degree fractal appears to be occurring now and is in fact stretching our M-top slightly. We initially thought that the inside weakness of our M-top might be occurring in August and September. We did approach some critical levels, but the drop seemed too light against what we thought would occur and, most importantly, would be required to prompt the next round of central bank initiatives. What we think is occurring is we are simply completing a final fractal before beginning the inside of our M-top. This is the sort of pattern that is required to kill the present level of retail euphoria in the market. And let me clearly state, as the chart on the right shows, this is only at the retail level. and those institutions forced by their prospectus to be fully invested or invested. Institutions that can't have already left or are in the process of leaving. My macroanalytics and financial repression authority guest, Graham Summers, recently penned the following, and I quote, "For 6 years, the world has operated under a complete delusion that central banks somehow fixed the 2008 crisis. All of the arguments claiming this defied common sense. A fifth grader would tell you that you cannot solve a debt problem by issuing more debt. There is no way that things are better now. After all, we just added another $10 trillion in debt to the U.S. system." Similarly, anyone with a functioning brain can tell you that a bunch of academics with no real-world experience, none of whom have ever started a business or created a single job, have the ability to save the economy. However, there is an awful lot of money at stake in believing these lies, if I can call them that. So the media and the banks and the politicians were happy to promote them. Indeed, one could very easily argue that nearly all the wealth and power held by those at the top of the economy stem from this fiction. So it's little surprise that no one would admit the fact. The Fed and the other central banks not only don't have a clue how to fix the problem, but they actually have almost no incentive to do so. There are 6 points here that Graham actually laid out that crystallize the point. First, the real problem for the financial systems is the bond bubble. In 2008, when the crisis hit, it was $80 trillion. It has since grown to over $100 trillion. 2, the derivative market that uses this bond bubble as collateral is over $555 trillion in size. 3, many of the large multinational corporations, sovereign governments, and even municipalities have used derivatives to fake earnings and hide debt. No one knows to what degree this has been the case, but given that 20% of corporate CFOs have admitted to faking earnings in the past, it's likely a significant amount. 4, corporations today are more leveraged than they were in 2007. As Stanley Druckenmiller noted recently, in 2007, corporate bonds were $3.5 trillion. Today they are $7 trillion, an amount equal to nearly 50% of U.S. GDP, to put it into perspective. The central banks are now all leveraged at levels greater than or equal to where Lehman Brothers was when it imploded. The Fed is leveraged at 78 to 1. The ECB is leveraged at 26 to 1. Lehman Brothers was leveraged at 30 to 1, and we thought it was atrocious. The central banks have no idea how to exit their strategies. Fred Minutes released from 2009 show that Janet Yellen was worried about how to exit when the Fed's balance sheet was only $1.3 trillion back in 2009. Today it's over $4.5 trillion. We are heading for a crisis that will be exponentially worse than 2008. Potentially, and strong probability. The global central banks have literally bet the financial system that their theories will work, and they are theories and experiments only. They clearly haven't in any form, and Japan demonstrates this quite clearly. All they have done is set the stage for an even worse crisis in which entire countries will go bankrupt potentially. Graham also wrote something even more recently about the $9 trillion debt bomb, and this is important, and I quote, "The U.S. Federal Reserve and European Central Bank have created a very dangerous situation now. Throughout the last 6 years, there has been a sense of coordination between the Fed and the ECB. This was evident both in terms of where capital went as well as how it was delivered via monetary policy. For instance, when the Fed released its discount window documents in 2011, it became clear that most of the funds from QE2 actually went to foreign banks located in the EU. Similarly, when the EU banking system was close to imploding in 2012, the Fed coordinated with the ECB to announce QE3 in an effort to prop up the EU banking system and calm overseas jitters to aid Obama's administration in its re-election campaign. In short, from 2008 to 2014, the Fed and ECB worked together. However, at some point this relationship was set to fracture. True, global central banks want to work together to maintain stability, but when every central bank is engaged in the competitive devaluation of its currencies, at some point the relationship between central banks would become fractured as they individually had to choose to aid themselves over each other. That point is today. The European comprises 56% of the basket of currencies against which the US dollar is valued. As such, the euro and the US dollar have a unique relationship in which whatever happens to the one will have an outsized impact on the other. The relationship first began to run off the rails in June 2014 when the ECB cut interest rates to negative. Before this, the interest rate differential between the euro and the US dollar was just 0.25%. The US dollar was yielding 0.25, while the deposit rate on the euro was at exactly zero. While significant, the interest rate differential was not enough to kick off a complete flight of capital from the euro to the US dollar. However, when the ECB launched NIRP versus ZIRP, cutting its deposit rate to negative 0.1, the rate differential, now 0.35, and punitive qualities of NIRP, it actually costs money to park capital in the euro. It resulted in vast quantities of capital fleeing euros and moving into the US dollar. Soon after the US dollar erupted higher, breaking out of a multi-year triangle pattern and soaring over 25% in a matter of 9 months. To put this in perspective, this move was larger in scope than the flight to safety that occurred in 2008 when everyone thought the world was ending. The reason this is problematic? There is over $9 trillion in borrowed US dollars sloshing around the financial system, and much of it is parked in assets that are denominated in emerging market currencies, the very currencies that have imploded as the US dollar rallied. This is the US dollar carry trade, and it is larger in scope than the economies of Germany and Japan combined. In short, when the ECB cut rates to negative, the US dollar carry trade began to blow up. The situation only worsened when the ECB cut rates even further into negative territory in September 2014, and again recently, bringing the rate differential between the US dollar and euro to 0.55%. Now the Fed is talking of raising interest rates. Even a symbolic rate like 0.3% or 0.5% could trigger a complete implosion of this $9 trillion US dollar carry trade. If you think this is just fear-mongering, you're mistaken. The Treasury Department issued emergency kits to employees a few months ago in anticipation of systemic volatility during the rate hike. Similarly, the Fed boosted the size of its market operations department in Chicago in case the New York Fed loses control of the system when the rates rise. In short, we could very well be on the eve of another systemic crisis. The financial elites have been preparing for this for some months now. There is little doubt the global economy is now slowing at a rate comparable to the financial crisis, and it is startling. But it seems to be left as a footnote to most coverage by any news source such as CNBC. I've discussed previously that the commodity complex and the energy complex began falling when the realities of the potential U.S. taper program would actually occur were first realized. We have felt since the announcement by the U.S. Federal Reserve its taper program that an inevitable collapsing commodity market in emerging economies would be the catalyst for the next crisis. We concluded in our thesis paper, The Globalization Trap, that a good proxy for a slowing China would initially be commodity prices and in turn the levered players behind the massive commodity run-up. Make no mistake about it, China is in the process of a hard landing, which is being once again temporarily camouflaged by a credit expansion. This is a ticking time bomb with players like Glencore at ground zero. Glencore is a highly levered player in a highly levered industry tied to a highly levered China. It could, however, just as easily be the Vitol Group, Trafigura, Gunvor, Mercuria Energy, Louis Dreyfus Commodities, Noble Agra, and I go on. This group alone has recently raised at least $125 billion of debt. Why? What is the panic? When these players' bonds are rated as junk, it will lead to numerous collateral shortfalls and margin call waterfalls, reminiscent of the ratings agency downgrade of AIG that culminated with the U.S. bailout of the insurer. Commodity traders have raised at least $125 billion of debt, of which about $75 billion is loans. In other words, there is about $75 billion in secured debt collateralized by either inventory and or receivable collateral whose value has cratered in the past year, and as a result, the loan-to-value on the secured loans has soared. It is this that is prompting the panicked banks to be more eager to provide funds to the suddenly distressed energy trading sector than even the borrowers themselves. Goldman Sachs' straw man for the next mega bailout I thought is interesting and goes roughly as this. Number one, commodity prices drop another 5%. By the way, that just recently happened. The rating agencies get a tap on their shoulders and downgrade Glencore and the others to junk. On the verge of that happening now. Waterfall cascade of margin and collateral calls liquidates Glencore's trading desk and depletes the company's cash, leaving trillions of derivatives contracts in limbo. Always remember, the strongest collateral chain is only as strong as its weakest counterparty. If counterparty liquidates, net exposure becomes gross, and suddenly everyone starts wondering where all those physical commodities are. 4. Contagion spreads as self-reinforcing commodities collapse, launching deflationary shock waves around the globe. 5. Fed and global central banks are called in to come up with a more powerful form of stimulus. And 6. The money pair drop scenario proposed by Citigroup becomes a reality, and what we expect will happen. Stay tuned. Things could get out of control very, very fast. Everything I described also is true for players and countries involved in the energy sector. Industries cannot withstand sustained price drops from $105 a barrel to $37 a barrel, or a 65% drop in revenue. Its fixed cost and debt simply kill it. This kind of drop takes countries with it. Look at Venezuela, or even what is now occurring in economic stalwarts like Canada. Profits as a percentage of revenue is killing emerging markets and the $9 trillion in debt obligations they have shouldered to keep up with the false signals and distortions the QE was giving regarding demand. As the U.S. dollar continues to rise and makes the debt overhang even worse, the hot money is escaping before emerging market currencies drop further. Brazil is now in a depression, not a recession. Investors don't wait for government and the statisticians to make always belated announcements. They leave. And that's what's happening. As more and more companies begin to default on their loan covenants and money becomes harder to get, the problem accelerates. Most markets around the world are already adjusting. The only market that isn't is the U.S. equity market, which is being held up by fewer and fewer companies like the FANGs and NOSH, which we wrote about in November's edition of Triggers, and of course, the stealth U.S. plunge protection team. Don't be fooled. This is exactly what is occurring. It will continue until the markets simply become too heavy to be artificially held up and something breaks. What everyone must realize is the credit cycle has reversed after 8 years. It reverses because corporate free cash flow shrinks, and therefore credit risk increases. It's not a decision. It's about the realities of the numbers. Debt levels to EBITDA are critical to lenders. They react and everything else follows eventually. It's just about mathematics. This reaction has already begun to occur in the high yield or junk market, where risk is the greatest. The number of distressed bonds has shot up. But there is much more going on than just this. There are signals of distortions and dislocations to a degree I haven't seen before. And I didn't see these in the market collapses of 1986, 2000, or 2008. Let's go through some of these, which are getting a lot of focus by institutional investors. Let's start with swap spreads, which are below zero and seemingly defy market logic. As Bloomberg reports, and I quote, "At issue is the fact that swap rates, or rates charged for interest rate swaps, have dipped below yields on the equivalent U.S. Treasuries, indicating that investors are charging less to deal with banks and corporations than with the U.S. government. Such a thing should never occur, as the U.S. Treasuries theoretically represent the risk-free rate, while swap rates are imbued with significant counterparty risk that should demand a premium. That may have changed, however, as new financial market rules require interest rate swaps to be run through central clearinghouses, effectively stripping them of counterparty risk and having just a minimal funding component. At the same time, funding costs for the U.S. Treasuries are said to have gone up due to a host of post-financial crisis rules that crimp bank balance sheets, causing costs to go up. The people who can arbitrage it away, their costs just went up a whole lot more. Next is the repo market. The repo market is the lubricant for the global financial system, allowing banks and investors to pawn their assets, typically U.S. Treasuries and other high-quality paper, and I need to put quotation marks around high-quality paper, in exchange for short-term financing. While there used to be little distinction between the rates at which counterparties raised money against their U.S. Treasury collateral, there is now an increasing divergence. You no longer have a single repo rate. The market itself is fracturing. You can see the trend in this chart. The first shows the rate for general collateral financing trades versus the Bank of New York Mellon's tri-party repo rate. The second shows the GCF repo rate minus the rate that money market funds earn on their own U.S. Treasury repos. All are slightly different repo constructs against the same collateral, yet the difference between the rates paid on each has been widening. Much of this has to do with new regulations that require banks to hold more capital against all these assets, regardless of their riskiness. The so-called supplementary leverage ratio makes it more expensive for banks to facilitate repo trades, placing more emphasis on quality of the counterparty and leading to reductions in rates. That is especially true at the end of the financial quarters when banks are encouraged to limit their leverage and window dress their balance sheets ahead of scrutiny from regulators and investors. This odd occurrence might not mean much for markets right now, but it could come into play when the Federal Reserve finally moves to raise interest rates. Much of the central bank's exit policy will rely on using a new overnight repo facility to withdraw excess liquidity from the financial system. At a minimum, analysts and the Fed may need to be more precise when they refer to repo and Fed funds. Corporate bond inventories are also below zero. Analysts at Goldman Sachs made waves when they highlighted the fact that inventories of some corporate bonds held by big dealer banks had gone negative for the first time since the Federal Reserve began collecting such data. That means big banks are now net short corporate bonds with a maturity greater than 12 months, equivalent to $1.4 billion, bucking the longer-term trend of net positive positions. The record-breaking event revived a flurry of concerns about so-called liquidity or ease of trading in the $8.1 trillion corporate bond market. Similarly to the repo market, a confluence of new rules is said to have made it more difficult for banks to hold corporate bonds on their balance sheets. At the same time, years of low interest rates have encouraged investors to herd into these corporate bonds and hold on to them tightly. Synthetic credit is now trading tighter than cash credit. Investors struggling to trade bonds amid an apparent dearth of liquidity have turned to a bevy of alternative products to gain or reduce exposure to corporate debt. Such instruments include derivatives like the credit default swap indexes, total return swaps, TRS, and credit index swaptions. The rush for derivatives that are supposed to be more liquid than the cash market they track has produced another odd dislocation in markets. This chart, the so-called basis between the CDXIG investment grade and index that includes CDSs tied to U.S. investment grade companies and the underlying cash bonds. The basis has been persistently wide and negative in recent years as spreads on the CDX index trade at tighter levels than cash. In exchange for the substantial liquidity of derivative indices, investors are often giving up spread right now, as most indices trade at a negative basis versus the comparable cash market. The negative basis right now is near the largest we have witnessed at a time when there was not a funding crisis. Investors may be ogling such synthetic tools not just because of their purported liquidity benefits, but also because of the funding benefits, a similar dynamic to the one currently pushing swap spreads into negative territory. These dynamics are part of a broader pattern, whereby cash bonds that require balance sheet financing underperform their synthetic counterparts. Much of Wall Street runs on mathematical models that just hate statistical anomalies. Unfortunately for the street, such statistical anomalies have been happening more frequently with short-term moves in many assets exceeding historical norms. The number of assets registering large moves, 4 or more standard deviations away from their normal trading range, has been increasing. Such moves would normally be expected to happen once every 62 years. While much of the confusion can be blamed on unexpected decisions by central banks, such as the Swiss National Bank's surprise decision to scrap its long-standing currency cap, there have been a sharp market moves with seemingly little reason behind them. Perhaps the best-known example is October 15, 2014, when the yield on a 10-year U.S. Treasury briefly plunged 33 basis points, a 7 standard deviation move that should happen once every 1.6 billion years. based on a normal distribution of probability. It tells you there are serious games being played. Some market participants have also blamed lower market liquidity for the wild moves. The argument is that an unexpected macro event or large-size risk transfer has the potential of creating much larger market moves today compared with the past. The taper tantrum and the October 15, 2014 event where Treasury rates moved amid very little news would be the same examples of these events in recent times. We now have volatile volatility. In October 2008, Lehman Brothers had just collapsed. Interbank lending had ground to a halt. The repo market seized up, and the future of the entire financial system was in question. At that time, a measure of expected volatility in the Chicago Board of Exchange Volatility Index, or VIX, hit 134.8. In August 2015, the stock market fell 5.3%, and the same measure of implied volatility in the VIX closed at 168, after reaching an all-time intraday record. Whatever one's opinion of the stock market sell-off, you'd be hard-pressed to argue that global markets were more stressed in August than they were during the depth of the financial crisis. Instead, the vacillations in the VIX underscores a post-financial crisis trend that has seen volatility explode into its own asset class itself. A host of exchange-traded funds, futures, and derivative products are now enjoyed by both big and professional fund managers and mom-and-pop retail investors. Meanwhile, some large investors have pumped up their returns by selling volatility, with PIMCO under Bill Gross perhaps the best-known example here. The volatility market that exists today is much more complex than it used to be. ETFs, indices, futures, and options traded on all of the above have complex relations that haven't been fully tested. Eventually, as we saw in the wake of last August, equilibrium is found when dislocations occur, but getting there can be complicated. Volatility, in my view, hasn't changed. What's changed is how it's warehoused and shifted. And the list goes on. But that is enough for you to get the idea. Something is seriously broken somewhere. Government interference by both central banks and regulators has created an ever more fragile situation in both the global economy and the financial markets. Price distortions and dislocations have been moving from one market segment to the next, and they keep growing, which indicates that there is a considerable danger that a really big dislocation will eventually happen. With that, we mean an event in which normally disparate market segments suddenly become highly correlated as a scramble for liquidity starts in one sector. The non-scientific name for such an event is crash. If you want a more scientific sounding term, Bob Bronson referred to it as a mass-correlated, hyper-volatile, illiquid event. Sounds like the title of the charts we just reviewed here the last few minutes. Extreme caution seems to be warranted in spite of the fact that money supply growth in the euro area and the U.S. ranges from extremely brisk in the former to sagging but still brisk in the latter. We simply don't know how much money supply growth is really needed to keep the wolf from the door in this brave new world of ZERP, NERP, and quantitative easing and QQE in Japan. Risk remains extremely high. That much is certain. In conclusion, let me reiterate, I continue to fully expect a Minsky melt-up before all this ends, very badly, likely in mid to late 2016. Eventually, it will be clear to all that the central bank policies have been an abject failure. The government policy of financial repression is becoming too heavy-handed. As productivity falls, high-paying jobs disappear, and tapped-out consumer demand steadily slows. We're killing the golden goose, in other words. I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, I hope 2015 turned out to be an outstanding investment year for you, and that 2016 will be the best ever for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.